Hey everyone, happy Friday. It's December 9th, 2022. We'll talk about this market sliding into the weekend, much like the Dutch chances in the World Cup here after the close here. We see the market accelerating to the downside in the last hour of trading, starting to react to the PPI number this morning. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The StockCharts platform was designed to help us try to make sense of uncertain markets in uncertain times. And boy, if you've not been frustrated by 2022 yet, I'm sure the last hour of trading today was just an exclamation point on the struggles of 2022. The market had one general configuration in the morning, a bit of a different sort of move back to risk off in the afternoon, but everything went wild in the last hour of trading, with the S&P going from flat to on the day down 0.75%, pushing down around 39.35. We're going to look at all the charts together here. On Friday, we have two main goals. Number one, wrap the week and sort of look at how the markets have changed from last Friday to this Friday. And number two, answering some of your questions from the Final Bar mailbag. Before we get there, I just want to let you know about the upcoming schedule. We had three really cool conversations this week. I was thinking a lot about my conversation with Frank Capillari yesterday. We were talking about failed breakouts. And when I see the market going into the close this weekend, reminds me of my conversation with Frank, where a bull market sees markets breaking higher and following through. We're not seeing that. Next week, we have a really good guest on Monday, special event. Jeff Hirsch, who's the editor of the Stock Traders Almanac, will be joining us on the show for a special longer form interview. We'll be talking with him about seasonality through year end into the first quarter and get a preview of the 2023 Stock Traders Almanac, which is currently on sale at the StockCharts bookstore. Also, Sean McLaughlin from All Star Charts joining us on Tuesday the 13th, Wednesday the 14th. Sam Burns, the chief strategist at Mill Street Research in Boston. One other thing, actually, we have a special event coming up next Tuesday. I'll be doing my latest free event with Market Misbehavior, a webinar called 5 Best Practices for Stops. We will talk about risk management, and hopefully you've had a really rock-solid risk management approach in 2022. But if not, hopefully this session will help you better plan for 2023 and beyond. It's coming up Tuesday, December 13th, 1 o'clock p.m. Eastern. You can sign up for that event at marketmisbehavior.com/stops. Let's continue on our show today with our Wrap the Week segment. As I mentioned, sort of two things we try to do on a day like today. Number one is Wrap the Week, which is focus on how the markets evolved from last Friday to this Friday. Then we'll talk a little bit about some of your questions from the Final Bar mailbag. To start out with, just to check in on what happened today, the S&P down 0.75%, and that's taking us down just above 39.30, closing the day around 39.34. What's interesting, to digress a moment, we asked you recently, thinking about risk assets accelerating to the downside. We asked you in a poll recently, where do you see Bitcoin 1 month from today? 10% higher, 10% lower, or within 10% of current levels? I was actually surprised by the negativity for Bitcoin, with 45% of you saying at least 10% lower, 41% of you saying within 10% of current levels, and very few of you saying at least 10% higher. I think that's pretty fair, and one of those two probably makes the most sense. I probably would put it within that second bucket, only because the more you look at this environment, there's sort of overreaction on both sides, right? You see the markets surprising to the upside in the short term, surprising to the downside in the short term. A day like today is one of those surprises to the downside, right? Sort of surprising with strength out of the open, but then accelerating to the downside going into the close. To get back to the chart of the S&P 500, just to talk briefly about what happened. I was looking at the markets before the open. I sort of had my morning coffee routine where you get a cup of coffee, you're ready for the day, fire up the laptop, and what do you start looking at? And the first thing I was looking at was the PPI number that came out before the open today. And the assumption that with the number a little higher than expected, the market would move lower, which it did before the open. From there, the market rallied through the course of the morning, and by lunchtime, the headlines that I'm reading on Bloomberg and other places talking about, the market shrugging off the PPI number and just renewed optimism that everything's going to kind of be fine. It's amazing how quickly things changed. And now all of a sudden we're reverting back to the downside. It's a great reminder. One of my mentors, Jeff Weiss, always reminded me, wait for the close, wait for the end of the week, wait for the end of the month. Everything else is noise. Wait for those final resolutions, the end of the day, the end of the period, whatever that is, because that can tell you a lot more about directionally what happened from one point to the next. You can see, again, on the preview chart, the S&P going lower. Quickly on what happened today, and then we'll look at my weekly chart just to make sense of the weekly returns. S&P down 0.75%, about the same for the NASDAQ. Small caps and mid caps both down over 1%. And the VIX started to move higher through the course of the day, spiking to the upside, finishing the day and its higher levels just below 23. Looking at interest rates here, you see interest rates pushing higher through the course of the day. And that's not just at the end of the day where you saw bonds selling off. That actually played out through the course of the day, where the 10-year yield went higher from just below 350 at yesterday's close to around 356, 357 at today's close. The dollar index moving up a little bit as well. Gold had a pretty decent day, but sort of rolled off in the last hour. Kind of everything rolled to the downside in the last hour, to be honest with you. Certainly risk assets, bonds, stocks, commodities sort of accelerated there. So a really painful way to end the week, and certainly an interesting setup to the Fed meeting next week. But at the end, even with the pullback, gold and silver actually finished in the positive. Bitcoin, Ethereum, both weaker through the course of the day, really, with Bitcoin nearing that 17,000 level, Ethereum just above 1260, but currently at its lowest level for the day. So overall, again, it's just classic preparing for this show. You have one general sense, and then the market completely shifts in the last hour of trading and shifts things around very, very quickly. Let's wrap the week next by looking at what I call my wrap the week chart. It's looking at weekly returns. So we're starting at last Friday's close. We're looking at the movements in percentage term of major asset classes between last Friday and this Friday. Here's the S&P in black, which finished the week pretty painful, down about 3.4%. Number of things underperformed the S&P. The NASDAQ 100, not too far below actually, but still down 3.6% for the week. In purple, we have small caps with a pretty rough week, right? Down 5%. That's an interesting one to think about, because one of the sort of bullet points in the bullish argument coming out of the October lows was the strength in small caps, right? Small caps have been underperforming for quite some time. All of a sudden, really starting to emerge in a position of strength, a nice rally and outperforming off of the lows, giving some of that back and a bit of a mean reversion to the previous trends here with the IWM down 5% for the day. The worst performer of all of these, crude oil down 10%. That's using the USO, which is a crude oil ETF or a bullish oil ETF. And it's interesting. We're going to look at the energy sector in a little more detail if we have time here in a moment, because concerning bearish divergence coming out on the chart of the XLE, a lot of individual names as well. It's by far the top performing sector in the markets, but really struggling here as of late. What outperformed the S&P this week? In orange, we have emerging markets down 1.3%. In red, we have bond prices, the TLT, which was down 0.7%. Gold, pretty much flat for the week, along with Bitcoin. Both finished within 0.1% of flat. The dollar index ends up being the best performer for the week, up about 0.5%. That's using the UUP. Just briefly to talk about what else we saw today. Again, it's sort of a different feel to the day earlier, where you had the offense, traditional offense at the top, traditional defense at the bottom. That's sort of fluctuating quite a bit. At the end of the day, the only sector up for the day was communication services, the XLC, which was up 0.3%. All the other 10 S&P sectors down today, with energy leading the way lower, 2.4%. Healthcare, which has been one of the shining lights, one of the bright spots in the markets recently, next to last, down 1.3% as well. We'll finish off here looking at the Mindful Investor live chart list, just to check in on how things have evolved and starting to try to get our head around what happened this week and setting up for next week. This is an exciting year for sure, and an exciting week. I was talking to a media outlet earlier today, and I shared with him that, bear markets are just way more fun. They're painful and they're challenging, but you learn so much more as an investor. Bull markets are boring. 2021 was a boring year. Things went up. Things kind of made sense. The Fed was injecting liquidity. It was not hard to recognize the signs of strength. In 2022, you have a lot of outliers, you have a lot of surprising moves, and you get a lot of mean reversion. And arguably, that's what we're facing here, right? The S&P potentially stalling out at its 200-day moving average, similar to August, rolling over. And again, that was a lukewarm thesis until the end of the day today, where you see a lot more distribution coming in, and you see the markets finishing basically at its weakest point for the week here. Our long-term model remains bearish, and it's been that case since the beginning of May of this year. The medium-term model is still bullish, but starting to turn down. Actually had a pullback week here off of the highs, and the question is, does it get below that zero level? The short-term model actually did get below the zero level. It was really, really close to zero, right around there, but the sell-off, again, going into the close, really sort of completed that transition. So at this point, I have my short-term model back negative, medium-term model bullish, long-term model bearish, a conflicted model, three-pronged model on 3 timeframes, and that is exactly how this market feels. The daily chart of the S&P, my conversations this week all sort of revolved around this. I thought Leslie Juflas had some really interesting thoughts about potential support on a drawdown using Fibonacci analysis and a number of other tools, really more pattern focused in her toolkit. I thought my conversation yesterday with Frank Capillari of Cap Thesis was pretty interesting as well, thinking about really the message of the market being unable to follow through. And that's how I would probably describe this market here. As we were pushing off of the October lows, as we were going higher, what I told my premium members at Market Misbehavior was, we have a series of overhead resistance levels. Let's track each of those. Do we meet them and do we eclipse them? And once we get through that last resistance level, that is the all clear, things are great, long and strong, up and to the right. This is a powerful market. And we got close to that, but we didn't complete it. And I'll tell you that the most notable failures so far to the bull case would be the big move above the 200-day moving average, and that was the high close. You never closed higher than that here in this swing, and just how beautifully that this recent upswing lined up with the previous highs in 2022. It's almost just a textbook trend line facing resistance, unable to get above there, and until we can get above a line like that, that just tells you the pace of this downtrend is still very much in play. We only have a minute left, so I just want to hit on a chart or two to finish off this segment. It's not all bad, and I don't mean to say that everything went negative on this close. It was just one day and 1 hour within one day that turned negative. When we think about the course of the week, obviously finishing weaker than we had in previous weeks, which was accelerating up towards the 200-day. But a lot of breadth measures still remain fairly elevated, right? 56% of S&P stocks remain above their 200-day, even though the S&P was unable to do that. Most stocks in the S&P 500 are above their 200-day moving average. That's bullish. Still 78% of the S&P above their 50-day. So I was doing an event for the Boston Investors Group earlier this week. A lot of IBD readers and users in that group as well. We talked a lot about sort of Bill O'Neill's approach. And one of the things that I really like about the simplicity of risk management from the O'Neill camp is basically thinking about percent movements and focusing on the 10-week or the 50-day moving average as a way to make sure you lock in potential gains and manage risk to the downside. Most stocks still are above their 50-day. This line gets below 50%, either of these, and that starts to tell you that that picture is changing. That is what would confirm to me that not just are we pulling back from resistance, but we're really beginning the next leg lower. I'm not seeing enough to tell you that is a likely future path. I will tell you, though, this short-term weakness begins the process of thinking about those potential downside objectives. Let's take a quick commercial break. We'll be back with my next segment, Power Up. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close. as we break down the activity in the markets using the best practices of technical analysis. 2022 has been a fascinatingly challenging year. I hope you are enjoying our work on this show. We have a lot of cool plans for the final bar in 2023 and beyond. We have our brand new studio, which we are finishing up. We hope to be in there in January. A lot of cool things, including expanding the show to cover more markets and bring on more guests and a lot of other cool segments as well. So stay tuned for a lot of great improvements to StockCharts TV and our show, The Final Bar. Other quick announcements before we continue. First off, we welcome your questions. We're going to do a mailbag segment here in a couple minutes, and we'd love to feature one of your questions live on the air on Tuesday's show of next week. You can get your questions to us via email, thefinalbar@stockcharts.com, on Twitter @FinalBarSCTV, and on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show of next week. Also, go to StockChartsTV.com. I mentioned my recent conversations with Frank Capillari, with Leslie Juflas, upcoming discussions with Jeff Hurst, special events by Larry Williams, Martin Pring, and many others. All are available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Our next segment is called Power Up. What we like to do every Friday is spend a brief moment or two powering up, leveling up your use of the StockCharts platform. We are working hard to improve the StockCharts platform. Our Camino release is coming up next week. Includes some really cool stuff like our new earnings calendar, our new options pricing analysis. All of that is going to be coming very, very soon. I can't wait to share some of the screens with you because they're going to be really, really cool, but not quite released yet. That'll be coming next week. But I did want to point out some of the tools we have to help you become a better investor. Hopefully, what a lot of the feedback we've gotten from many of you watching this show is it's helped you just bring additional perspective to the markets, trying to make sense of things, thinking about risk and return and the best practices of technical analysis. What I wanted to point out is on the StockCharts platform, we have a lot of great expertise from not just me, but many others who have seen things in these markets over many decades. If you go to StockCharts and click on Charts and Tools, scroll down a little bit, and you find a lot of different things to pay attention to. All to the bottom, and there's also a link at the top. We have our Chart School section. This is a free portion of the StockCharts website. Whether or not you're a paid member, you have access to this. I will tell you, learn the lessons here and then use the paid membership on StockCharts to really improve your own returns. But one of the things I wanted to highlight is if you go to the main page on Chart School, it's kind of hidden, but if you click on Overview, we have some really cool writings that we've captured. John Murphy, who really was who is our chief technical analyst and was really one of the first outside of our founder, Chip Anderson, to really inject a lot of technical analysis wisdom into StockCharts.com. A lot of his work is featured here, including his 10 laws of technical trading, which I would strongly encourage you to review. What I want to point out for you is a section called Random Walk versus non-random walk. There was a podcast I was directed to earlier this week. I thought it was absolutely hilarious. They interviewed the editor from the FT, the Financial Times markets page in London. She had created this vomiting camel sort of fake chart pattern, and it ended up going viral with people thinking it was an actual pattern. I have learned that the highest form of humor is laughing at yourself. So as a technical analyst professionally, I thought it was absolutely hilarious. So they interviewed her and also interviewed Helene Meisler, who we featured on our show and on our channel, talking sort of giving the alternative point of view about why technical analysis could work. Now, while I don't agree with all the conclusions they made on the podcast, I thought they covered the ideas very well. And one of the things they referred to is what's called the random walk. It has been prevalent at times in academia to say that there is no ability, none of us can predict future prices. And that's not just technical analysis, that's quantitative analysis, fundamental analysis, economic analysis. None of that can tell us what comes next because price movements are random. Andrew Lowe is a professor at MIT, and he wrote a book called A Non-Random Walk Down Wall Street, which I have on my bookshelf. It is super meaty. It gets into a lot of data and a lot of data crunching, but in the end, he proves through his data analysis that there is information embedded in price, and technical analysis works because price has value, price has information. So if anything I just said is intriguing to you, go to our random versus non-random walk article that is in the overview section of our Chart School page. That is your level up or power up segment for today. Let's continue on with the Final Bar mailbag. As a reminder, the mailbag is always open. The Final Bar at StockCharts.com is our email. Let's get to question number one. Let's see. You actually asked a number. You mentioned a number of things in your question. You find that trend lines drawn on log scale charts are different from regular scale charts, which makes you feel confused. And your question is, under what conditions should we use log scale charts over regular scale charts, or what I would call an arithmetic scale? It's a really interesting question. I really appreciate you sharing it with me. I don't have a great example readily available, and I'm sorry I don't, but I will probably bring up something like ConocoPhillips, something that's been in a pretty good uptrend. So here's what happens. This is what happens, right? My charts are all in semi-log scale, and if I ever show you a chart that is not in semi-log scale, that's either an accident, which has happened. I am certainly not perfect. It also could be because we are charting something that's already in percentage terms. So you really don't need log scale, but that is something that I've spent a lot of my career sort of debating and arguing with others in the industry about what are the best practices. If you look at the chart of ConocoPhillips, start at the beginning of 2021, connect the lows in February and August, connects here with July, and it kind of gives us a downside objective around 95. The reason why that trend line should have value on a longer term time frame is because log scale basically uses an equal percentage term on the y-axis. And if you're looking at long-term analysis, I would say 10 times out of 10, you need to be using log scale charts because it's a much better representation of what is actually happening in the markets. If I try to do that same analysis, but at the bottom, if I take off log scale, you'll find that the chart will change a little bit. And these lines actually won't line up as much. Now, again, I haven't looked at this example yet, so I might be totally wrong, but I'm betting it's probably not. So here, look, that same trend line, you see how it doesn't really match the prices. Now, the thing is, this is actually a fairly consistent percent gain in ConocoPhillips. But because I changed this, and this is now in dollar terms, it looks like the chart is getting away from the trend. It looks like the price is actually accelerating. But that's not the case. On a percentage basis, it's fairly consistent. So if you're looking at a 1 hour chart, if you're looking at intraday movements, log scale, arithmetic scale doesn't matter at all. If you're looking at long-term trends, and I see you not using a log scale, I will call chart foul. I will call chart penalty. You will be in the penalty box for charting, and that is the reason. That was pounded into my head early in my career, but my time at Fidelity, the chairman of Fidelity, literally out of 800 charts we would have in the chart room, he would find one that did not have log scale, and we would hear of it in a very heated fashion from the chairman if we did not use log scale, and it was for that reason. That's why log scale is so important. A lot of great writings from Edwards and McGee, from John Murphy and others on why log scale makes sense. Next question. Why do you use the 40 and 150 period moving averages on your weekly chart and not the 50 or 200, which is what a lot of people use on both weekly and daily charts? That's actually a really good question as well. On the same chart of ConocoPhillips here, I have the 50 and 200-day moving averages. And again, I use those because those are the most commonly used. And investors I've worked with, let me make it back log scale. The chart doesn't even look right when it's not on log scale to me, but that's, see, this is a consistent uptrend, right, on percentage terms. That's why that's important. Sorry. Current question. The moving averages, 200-day moving average, by far the most commonly used. The 50 is used in a lot of platforms like O'Neill and others as a way of managing risk. I've become very confident in the ability to use those moving averages to make sense of trends. But when I switch to my default weekly chart, I'm not using the 50 and 200 week moving averages. I'm using the 40 and the 150 week. Here's why. Look at this red line. That's the 40 week. Look at this red line is the 200-day. You can see how they're about the same. Now, they're a little bit different because this is using the last 40 weeks. So it's using weekly closes. This is using the last 200 days. So more data points, but it's smoothing out over the same time period. These should be very similar. At times a little bit different, but not much, right? So that's the idea. The 200-day is so important that on the weekly charts, I still want to know where we're at relative to that 200-day moving average. So the 40-week is a pretty good proxy, and that's why it's important. But if I'm looking at weekly data, and I'm looking at 5 to 7 to 10 years, something like a 50-period moving average is not telling me much more than what I've seen otherwise. So the 150-week is something I started using years ago just on weekly charts as sort of that longer-term time frame. So if you think about it, I basically use the 50-day, the 200-day, and the 150-week. And depending on whether I'm looking at the daily or weekly charts, I pick which of those two that I'm gonna pay attention to. Now, others use the 50 and 200 period on any charts. That is totally fine. That is not the methodology that I use for the reasons that I outlined just now. Next question. I saw a video on ascending wedges, and they said the steeper line is the weaker line. Is that always true of triangular consolidations, which is a great phrase? You also followed up, as a follow-up question, you don't talk about patterns much. And why is that? So the short answer to your question is no, that is not a phrase I've heard. I'm not familiar with the video or what is. I am very familiar with ascending wedges, which is basically a wedge pattern is where you have price. I feel like ConocoPhillips is going to be my example for everything. A wedge pattern, this is not the ideal wedge pattern, but it gives you a sense of what it's going to kind of look like. It's kind of like where you see this, right? An extending wedge is where there's a consolidation period. You think of like a pennant as something like this, higher, lower highs, higher lows, kind of an equilibrium. A wedge is where both of the lines are increasing or both of the lines are decreasing. And that tells you a little bit about it. An ascending wedge pattern, the steeper line is the weaker line. I'm not going to say anything about that other than no, I'm not familiar with that. And no, I would not attribute any greater value because of that, of the steepness or flatness. Maybe I'll send me the link to what you're referring to, and I'd love to take a look at it. Is that true of triangular consolidations? This goes back to your follow-up question, which is you don't talk about patterns much. I do talk about certain patterns, and I would say support and resistance levels, what I call basing patterns, I talk about often, right? Which is a consolidation phase. And then we break out because I like patterns that tell me about the behavior of investors. A flag or a pennant is a consolidation. It's the market sort of reaching into some sort of equilibrium before we resolve. So I like that sort of tension and release or consolidation and breakout because I've found that has happened so much. Wedges and some of the more obscure patterns I am less familiar with, and I mean familiar with them, but I use less often because I've not found. I have other tools to tell me when the price is reversing. For me, wedges don't add anything incrementally to what I might be seeing elsewhere. So I'm sorry for giving you a non-answer, but no, that's not something I've necessarily found. Wedges are not a pattern I use very often, but if you have someone that does, I'd love to take a look at it. Shoot me an email with a link to the video. I'd be happy to review it a little bit further. That's it. The show goes by so quickly, but we got to wrap it up. Let's go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. Netflix. We're looking at the candle chart of Netflix. And the reason why I wanted to highlight is because of today's candle, which you could call a shooting star candle. You might call it a gravestone doji candle. And it depends on how close this open and close are. A doji candle is when the open and close are basically identical. So this candle back here where it looks like a cross, right? The vertical axis giving the high and the low. The open close are basically at the same level. That's a doji candle, which represents indecision. What you see on the chart of Netflix is an open. We trade higher to a new swing high, but then by the close, we're right back and actually just below the opening price. I'd probably label that more of a shooting star, and it's about as negative as it sounds, right? It's sort of coming down. It tells you that early demand was met by additional supply, or early optimism faded, early buying power dissipated, and the price moved lower. That is a negative suggestion for arguably the best performing FANG stock going into next week's crucial Fed meeting week. Chart number 2, the energy sector. I mentioned the bearish momentum divergence that I noticed on the chart of the XLE, and this is what I was talking about. If you look at a weekly chart of the XLE, it's a lot more obvious than on the daily chart, so this is a longer-term pattern. But if you look at the last 6 months, you can see the high in May, June. You can see the high in October, November, higher highs in price. Look at how the momentum was overbought on the first attempt, not overbought on the second attempt. That is a bearish momentum divergence, higher highs in price, lower peaks in momentum, and that is not a bullish sign. That suggests an exhaustion of upside momentum. That suggests that the buying power that got us here has dissipated. So that divergence combined with the 9% loss this week, 8.5%, tells me to be skeptical of further upside in energy. This is one of the many things that I'm processing as I'm getting ready to write my weekly note for premium members for tomorrow morning and thinking about how to approach the Fed meeting next week. Finally, an hourly chart of the S&P 500. I don't know if I've ever actually shown an hourly chart on this show, and if I have, it's not been often because I'm usually looking more at daily, weekly, and monthly charts. But I do look at the hourly time frame, and it's just as I was thinking about Frank Capillari's comments about failed breakouts. You look at what happened at the end of November. This is that acceleration to the upside where we pushed up towards 4,100. We touched it on the hourly chart. Look at how quickly or how beautifully we hit that 4,100 level we talked about, and that was it. That's been the high watermark. Look at the 5th and the 6th, Monday and Tuesday with this distribution, and then a bit of consolidation. And the question here is I'm looking at the MACD or the PPO at the bottom. Do we follow this normal cyclical pattern of a downtrend, an uptrend, a buy signal off of the lows, and the rally phase that we've seen here over the last month? Arguably, we're really close to a sell signal. This hourly chart may be an important one to watch going into next week and Monday's session. Folks, that is a wrap for this week. Thank you so much for joining us every weekday after the close for the Final Bar. It's such a pleasure to bring you this show. A lot of great things planned for the Final Bar and on StockCharts TV in the new year. But until then, have a fantastic weekend. Be well, stay safe. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.